This just crashed by 45%. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today: the world isn't ready for what's coming in 30 days. Now let's head over to Fox Business, where we picked today's story up, because I want you to understand that what's going on in the world is going to have a direct impact, not just on the global economy, but the U.S. economy as well. And this is coming at a time when many people believe that we finally entered this Renaissance period, this mythical soft landing. And yet, as you're about to see, it's going to be anything but soft. Now, again, let's head over to Fox Business with the headline: freight through the Suez Canal sinks 45% amid Houthi attacks, and about 39% fewer ships have passed through the canal at the start of December, leading to a whopping 45% decline in freight tonnage. And this is huge, because this isn't just going to impact the global economy. As I'm about to show you, this is going to have a direct impact on the U.S. economy, and it's going to hit us starting in about 30 days. The UNCTAD has warned of risks of higher inflation. Yes, that will happen. Uncertainty about food security and increased greenhouse gas emissions due to the sharp decline. We're very concerned, they said, as we're seeing delays, higher costs, and higher greenhouse gas emissions. The Suez Canal is a critical shipping lane, given that it offers vessels a direct route between the North Atlantic and North Indian Oceans via the Mediterranean Sea and the Red Sea. About 15% of world shipping traffic, including 30% of global container trade, passes through the Suez Canal. But to avoid being attacked or having their cargo stolen, many ships are now sailing around the Cape of Good Hope, which is a much longer way around the continent of Africa. And this is just the beginning of what we see as an increase in consumer goods prices here in the U.S. And of course, it won't just be us, it'll be other parts of the world. But if demand doesn't meet this, if consumers cannot afford these higher prices, well, it's going to backfeed across the entire global economy, as you'll see here in a bit. Because here is the reality for the U.S. Consumer Price Index. As we look at the import price index against all commodities in red, both on a year-over-year rate of change, and right now the import price index is in contraction. Now, I have them on both on the same side of the chart, but if you notice, during periods where import prices are rising, what happens is that either flatlines the consumer price index, or in other periods puts upward pressure on it. So this is a big issue. If we start to see a swing of import prices to the plus on a year-over-year rate of change, well, this hope that we're going to see inflation get down to 2%, well, that path still may happen, but it may not be as fast as central bankers are hoping. That puts us then in a situation where the yield curves and the money curves may stay inverted for longer, as of course central bankers around the world keep rates elevated. They risk doing that any longer. Of course, I think we've already gone too far. You further constrict the creation of money in the debt-based economy, at some point everything comes slamming to a halt. So this is a big issue here, and this is going to impact U.S. consumers in a big way. And there were now 3 key global trade routes that have been disrupted, also including flows of grains and oil since Russia's invasion of Ukraine, and the Panama Canal, where low water levels from the drought meant shipping last month was down 36% year on year and 62% from 2 years ago. UBS has estimated that routing ships around Africa, which increases the journey length by about 2.5 weeks, reduces an Asia-Europe trip's effective capacity about 25%. Those longer routes and vessels traveling faster to compensate for detours means emissions are also rising, not to mention what we know is costs are going to go up. And the idea here that we're seeing a slowing economy and these costs are going to be absorbed by the shipping companies or the manufacturers, well, that's not going to happen at all. And spot container rates recorded their sharpest weekly increase of $500, affecting not just Asia to Europe shipments, but also the non-Suez route to the U.S. West Coast, which is more than double. However, rates were still only about half of the peak hit during the COVID-19 pandemic. But in any effort to get inflation down, we need to see across the board. We need shipping rates to decline. We need everything, energy costs, we need it all to happen. And this is going to cause an additional issue, which will indeed get passed on to U.S. consumers, because there's no way, again, that manufacturers or corporations or wholesalers that can absorb this additional cost. So it will indeed hit consumer shelf, most likely starting in about 30 days. But something that should be recording their sharpest weekly increase, well, that's your trading account, at least based on the setup. And we've been talking about what's going on in China, and many of you have been wondering, when are you going to have those updates to your reports? Well, I told you we had a preview from the programmer the other day. You said you wanted the signals when they switch to say what to buy on the first page. Well, it's good news, it's coming, because something that's going to be a big boost for you is going to be this FXI. We can see this is a China ETF. The last time it was down to these levels, it rallied 50%. Now, could you imagine what that would do to your investment accounts? Well, let's show you the setup here, because on January 25th, now you remember I featured this on the show the other day, our Momentum Timer Pro, which looks at all those technical signals, the RSIs and the MACDs and all those things that people are trading and doing it wrong. We pull them all together, smooth them all out into one clear signal, because you look at the Chinese here ETF, and what do we know? On a 1, 3, and 6 month window, it's saying momentum's to the negative side, and then now it's flipped. That was the first signal we wanted. Next, we said our machine position came a day later, this on January 26th. We see the short covering on the machines, and this is great because we run a historical overlay. This gives you the edge. So now you have all the tools to put a buy and open trade in on this. Should have put one on Friday if you're a subscriber, but still have chance on Monday going forward. The opportunity here is great, and you can get these signals every day to help you become a better trader. Right now, there are 3 coupon codes for a free month for each report. Grab them before they're gone, because as soon as the programmer's done, well, it's getting launched subscribers immediately. But one issue, of course, we know is these higher prices are not likely to be absorbed by consumers, because one of the challenges is when you see periods of declining income. And now we're going to look at this chart here of total compensation, which is in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisor employees. This shown in red against the consumer price index. You'll see the problem here is you have periods where the consumer prices are rising, and you think, okay, well, shipping costs could backfeed, put some upward pressure here. Maybe energy prices go up because these shipping companies are using more energy. So these are going to be all relative factors here. But what happens if you have a period where total compensation is declining? Well, those prices, they cannot be absorbed by consumers. And you can see typically it leads to either a recession, as we see here in the early 1990s, or the global financial crisis, or what was almost a global recession going into 2014, 2015, as demand went down. Of course, there's another knock-on effect that happens here. We'll look at in a moment. So here's the factor. We see compensation in red going down. Will consumer prices shift to the upside here? That would be one of the worst things for the U.S. economy right now, as everyone believes that finally wage growth is outpacing inflation. But indeed, if we see higher costs, and yes, that would be bad for the economy, but it would not lead to higher wages. That's the key, because these are embedded costs that have to get passed on consumers. There's no way companies can pass on higher wages at this time. But here is the other issue here. When you see a decline in wages, this is the big impact that's coming to the U.S. economy that we could see more of in the next 30 days. So not only do you have this issue of higher prices, but what happens is when you see demand go down because consumers cannot afford those higher prices, well, that means it's likely that layoffs are going to continue. Here we have continued claims against total compensation. We can note that periods where compensation growth is falling, well, continued claims are rising, because when you have less workers on your payroll and you can see demand going down, well, they realize too they're not going to continue to get the big raises. And sure enough, you see this effect over and over again. So this makes us now wonder that we already are seeing about 1.833 million Americans, according to the seasonally adjusted numbers, that are on continued claims. And what if this number is real? The non-seasonally adjusted at 2 million. If those numbers start to go up over the next 30 days, which is entirely possible, you have the case now that we're headed into a recession. And we've been wondering, what is this tipping point that's going to send the world down? Well, the beginning of it could be just something as having to reroute shipping lanes over a conflict. And yet, what that means is something needs to get resolved, and quickly. The problem is, I don't think there's going to be a resolution anytime soon. ABC News now talks to the Joint Chiefs Chairman, who says the U.S. goal in the Red Sea is to deter the Iran-backed Houthis, and we don't want to go down a path of greater escalation. I think the goal should be to stop it completely and get those shipping lanes back open, because let me show you what's going on in China, and you start to see how one small thing can start to tip a slowing global economy right over the edge. And here we can see suggestions by critics that the Biden administration isn't being tough enough on these militants or in Iran, which the U.S. accuses of financing attacks. And Brown, who is the chairman, is President Joe Biden's top military advisor, he said, I would also ask, well, what do they want? Well, Brown, I'll tell you what we want. We want the attacks to stop. We want the shipping lanes reopened. Do you want a broader conflict? Of course we don't. Do you want us on a full-scale war? No. We just want you to protect our ships and get those goods flowing, because now we start to look at, where does this beginning of this downfall hit? It's not the U.S. economy. Remember, it's always the exporters. Now let's head over to China. And what do we find out? The industrial profits fall in 2023 as demand remains weak. And this is a challenge, because if you have anything that further reduces demand, which in the U.S. economy right now would be higher prices and further unemployment, well, you have even bigger problems for countries like China. Industrial profits at large-scale Chinese companies decreased 2.3% last year from 2022. Again, that's deflation, my friends, as the annual number contrasted with an end-of-year surge after December profits soared 16.8% from the same month in 2022. Now, keep in mind, China's economy was closed a year ago, so there is some relativeness to these numbers. The other factor here is we see that seasonal demand from back to school, holiday season. Will that persist? No, the answer is not likely here. And that was a slower pace than November's 29.5% increase, as both months reflected a rebound in output from a year earlier when nationwide COVID outbreaks shuttered factories in many major cities. So we don't have very fair comps from a year before. But the issue is with industrial profits, even though they've been improving since last summer, it's a sign that companies are approaching the end of their destocking cycle. Well, that is the hope, or maybe we're just seeing that demand from newer goods is causing, of course, production to increase. Maybe it's seasonal goods. There's other factors here. The question is, can U.S. consumers and other consumers around the world at this time absorb the price of higher consumer goods? The answer is, I don't think so. And here we can see in another positive sign, industrial output expanded 6.8% in December, the fastest pace since 2021. A year-on-year decline in producer prices also slowed from November, reducing the hit to profitability. The problem is, when profitability goes down, well, there's something that comes with it. And total industrial profits are determined by changes in output, prices, and profit margins, as industrial producers increased their margins over the course of 2023 as they cut cost per unit of revenue. So one of the challenges here, and again, we don't always see this in the U.S. data first. We start to see it in other parts of the world. But if demand goes away and profits start to decline, well, that has a big impact on the workforce. And here you can see, based on the U.S. data, right now we're seeing a little bit of a renaissance as industrial production rises. Of course, we're going to make the case here that rather than go overseas, we're going to see order books start to domestically shift to U.S. providers and manufacturers, from the simple case as they can get the product done maybe at a cheaper price without when you factor all the additional shipping costs and time to come from Asia. So there's that factor here too. But if you see there's a slowdown in industrial production in other countries, well, let's look back at what happens in the U.S. during slowdowns, and it's very, very clear that when you note that industrial production shown in red on a year-over-year rate of change goes down, well, what goes up with that is continued claims. And you can see periods where industrial production goes up and claims go down. So the question is, will we see claims start to fall here if U.S. industry starts to get a nod from domestic consumption? Well, that will be a big help in keeping the U.S. economy running and making everyone believe in the Goldilocks scenario. But if global demand continues to go down, well, U.S. industrial production will likely decline, and that will lead to further unemployment. And so you see these challenges going around the world. It's not just the U.S. economy that's going to have issues over the next 30 days. It's other countries' economies, particularly China and other major exporters. If they see demand go down, well, that means, of course, they're going to face a slowing economy, further layoffs, and that's going to lead to a huge call, and you guessed it, for more stimulus. As China signals more targeted stimulus to come, as the People's Bank of China surprised investors on Wednesday by revealing a bigger than expected rate cut weeks in advance. Could you imagine if Fed Chair Powell came out and says, you know, in a couple months, we are absolutely for certain going to cut rates? The market would go bonkers. Of course, Fed never does that ever, but China is doing that to give its economy a much needed boost. And economists see the central bank following up on that move by steering credit into select areas, along with a handful of trims to the amount of cash banks must hold in reserve and modest policy rate cuts. Of course, we know that that usually is a boom for investors to get into the equity market, which is why we think and why I showed you that data on the FXI trade and why our subscription reports are just so valuable for your trading account future. And rate cuts will likely be more infrequent going forward and only used as a signal tool when markets are performing particularly poorly. This is from the chief economist for Greater China and North Asia at Standard Chartered. Structural tools will play an even bigger role. That is until the global economy starts to go down. And of course, we know that, again, it comes back to these higher costs are just going to be shipping costs passed on to consumers. This is like when we saw from UPS and FedEx where they had a fuel surcharge. Of course, that didn't mean that wages went up to employees. It just meant, well, the cost of fuel went up, so we have to charge you more. And so right now we know that, of course, workers want higher wages. They need higher wages to be able to sustain inflation. This is not going to help them. This is going to drive consumer goods prices up at a time that they're barely getting their heads back above water. But meanwhile, Yellen says, forget all of that. The jury's still out on the return to a low-rate era, signaling a shift coming. Well, of course, Miss Yellen, we got you wrong on this one. It does mean a low-rate era is coming. In fact, in your own words, we'll prove that. And there are people who feel quite strongly that nothing fundamentally has changed. We could argue that what's fundamentally changed is shipping times and costs around the world, and they will eventually settle back to levels that prevailed before the pandemic. She's referring to inflation here and interest rates. But the strength of the economy suggests that perhaps productivity growth and potential output growth have increased to the level that would be higher. Now, keep in mind, going into the pandemic, what was the Fed doing? I think Ms. Yellen got this wrong. They were cutting rates in a big way. It had nothing to do with the pandemic. In fact, we look back, Powell saw the yield curve start to invert. He panicked. He started doing QE, started cutting rates. And yes, that means we're going back not just to a lower rate. We're going back to zero. We were there once and then twice. Third time we'll be there, because sure enough, when you see international trade go down, and that means demand is falling, that's shown in red on a year-over-year rate of change. You notice a beautiful relationship with the consumer price index. So if prices go up to U.S. consumers and they don't respond by buying it, well, that means trade is going to go down, demand's going to go down, industrial production is going to go down, unemployment goes up, and next thing you know, the whole system starts to snowball. And a year ago, Yellen said persistently weak inflation was likely to return as a long-term challenge for the economy. Well, that would mean rates have to go lower. She also said that last January, I don't think we're in any way back to the 80s and 70s, a period when benchmark rates were notably higher than during the first 2 decades of the current century. I'll agree, rates are indeed coming down. She thinks a little bit, I'll say a lot. She said the higher long-term rates would come in hand with higher long-run rate of growth in the U.S. economy. Now, that statement is true, and a higher growth rate is a fiscal positive until you realize that when long-term rates continue to come down, it means growth and inflation expectations in the future are crumbling. We're still in this renaissance, though. Think about this. We're in the eye of the storm in terms of where the economy is at. Everyone still believes now that the soft landing is here. Well, just hang tight, as we'll see in the next 30 days, because Yellen has long said that U.S. debt burdens remain manageable. Well, I think many of you disagree with that. Instead of tracking overall borrowing as a proportion of the economy's size, which has reached a level that alarms many economists, commenters, well, and many of you, she watches the cost to service the debt, adjusted for inflation, as a percentage of GDP. And so far, the increase in borrowing obligations and higher rates haven't moved that measure substantially. But she has also conceded if interest rates remain elevated, of course, we'll know that's not likely to happen, that would spell trouble for the country's ability to carry the debt load and finance the rest of the U.S. budget, meaning, and we talked about this yesterday in our show, that, of course, right now, the government is debt financing the economy. If they're forced to cut their spending, well, that means the economy stands no chance because it can't stand on its 2 legs right now. Everybody is hoping and praying that we achieve this soft landing, because if we don't and the government's forced to cut, well, of course, we know that won't happen. Then we'll have to worry about cutting debt because the Fed will be back at zero before faster than a blink of an eye. But nevertheless, you can see the problems coming, and it starts to materialize in the next 30 days. I'm Steve Van Metre. Again, thanks for watching. Thanks for being fans. Bye now.